Hello and welcome to today's learning session on the EU emission trading scheme for the maritime sector. My name is Yulia Pavlenka, and I'm a senior manager in the climate risk and sustainability team within BDO's audit quality department. My core focus is on climate risk assessment and sustainability reporting. I'm delighted to be joined today by my colleagues Bernd and Joanne from BDO's corporate reporting team. Bernd is a partner and Joanne is a senior manager, both bringing deep expertise in complex financial and sustainability reporting matters. And they will be sharing valuable insights later in the session around the financial and accounting implications of the EU ETS. Before we dive in, here's a brief overview of what we'll be covering today. We'll begin with a high-level introduction to the EU ETS, exploring its core principles and how it functions, particularly in the context of the maritime sector. Next, we'll turn our attention to some key carbon accounting considerations, highlighting what shipping companies need to know from the reporting perspective. And finally, we'll bring these concepts to life through a practical case study, demonstrating how the EU ETS plays out in real life. So, without further ado, let's get started. Let's begin with a foundational understanding of the EU ETS. The EU ETS has been shaping carbon markets since its launch in 2005. It was introduced as part of the EU Green Deal, aimed at achieving climate neutrality by 2050. At its core, the scheme is designed to limit greenhouse gas emissions from industries within its scope. EU ETS operates on a cap-and-trade principle, setting a limit on total emissions from carbon-intensive sectors. Companies receive or purchase allowances, each gathering the right to emit 1 ton of CO2. If the company emits less than its allocation, it can sell the surplus. If it exceeds its limit, it must buy additional allowances. Importantly, the cap decreases annually, pushing industries towards greener practices in alignment with EU climate goals. Historically, EU ETS has covered power and heat generation, heavy industries like steel and cement, chemicals, and commercial aviation within the EU. Since 2024, its scope has expanded to include the maritime sector. Geographically, the scheme applies across all EU member states, European Free Trade Association countries, and Northern Ireland. A vital pillar of EU ETS is the Monitoring, Reporting and Verification System, MRV, which ensures emissions are tracked transparently and accurately. Companies must monitor their greenhouse gas output, report findings, and verify data to uphold regulatory integrity. This system guarantees that the process isn't just about compliance, but about driving real accountability in carbon reduction. It's also worth noting a recent development. On 19th of May 2025, during the UK-EU Reset Summit, the European Commission and UK government agreed to work toward linking the EU ETS and UK ETS. This future linkage would include domestic and international maritime transport, potentially streamlining compliance for companies operating across both jurisdictions. But why extend the EU ETS to maritime transport now? It is a very important question, and there are several strong reasons behind this move. First, the emission impact. Maritime transport is responsible for about 3% of global CO2 emissions and roughly 13% of transport emissions within the EU. Without intervention, these emissions could rise up to 250% by 2050, driven by growing global trade. Second, the regulatory gap. Historically, shipping has not been taxed on fuel or subject to carbon pricing, unlike other sectors. This has created an uneven playing field. Extending the ETS helps correct that imbalance and ensures all sectors contribute fairly to climate goals. Third, alignment with EU climate policy. This extension supports the European Green Deal and the Fit for 55 package, which aims to cut emissions by at least 55% by 2030 and reach climate neutrality by 2050. The maritime sector must play its part in achieving these targets. And finally, the role of the ETS itself. By putting a price on carbon, the ETS encourages investment in cleaner technologies, such as low-carbon fuels, wind propulsion, hydrogen. These innovations are essential for reducing sector's environmental footprint, and the ETS is designed to accelerate their adoption. Let's now explore what this means in principle terms for the maritime industry. As previously noted, the inclusion of the maritime sector in the EU ETS officially commenced on January 1st, 2024. The primary objective of this policy is to reduce greenhouse gas emissions from shipping by requiring companies to purchase and surrender emission allowances corresponding to their verified emissions. This regulation applies to vessels exceeding 5,000 gross tonnage, regardless of their flag when they call in at the ports within the European Economic Area. The extent of the emissions coverage depends on the nature of the voyage. For intra-EU voyages, those that begin and end at the ports within the EU, 100% of the emissions are covered. For voyages between an EU port and non-EU port, 50% of the emissions are covered. This distinction reflects the international character of maritime transport, while ensuring that emissions linked to EU trade are appropriately addressed. From 2024 on, the carbon dioxide emissions are subject to surrender obligations. From 2026, the scope will expand to include additional greenhouse gases. Shipping companies should begin preparing for this broader compliance requirement. A key feature of the maritime sector inclusions in the ETS is that no free allowances are granted. Unlike certain other sectors, shipping companies must purchase all allowances needed to cover their emissions. To facilitate a smooth transition, the surrender obligation will be introduced gradually. 40% of verified emissions in 2024, 70% in 2025, and 100% from 2026 onwards. It is important to note that the EU ETS is a directive, not a regulation. This means that while the framework is harmonized at the EU level, each member state is responsible for transposing it into national legislation. As a result, implementation details may vary slightly, depending on the country in which a company is registered or operates. To the next slide, please. Let's take a moment to clarify which type of vessels fall within the scope of the EU ETS. As of January 2024, the EU ETS applies in full to cargo ships and passenger ships. This applies to vessels 5,000 gross tonnage or greater. Beginning in 2025, additional vessel types will be brought into the MRV-only scope. That is, that will be requiring to monitor, report and verify emissions, but not yet be required to surrender allowances. This includes offshore ships of 5,000 GT or more, smaller ships ranging from 400 to 5,000 GT. Looking ahead to 2027, offshore ships of 5,000 GT or more will transition from MRV only to full ETS compliance, meaning they will also be required to surrender allowances. As for smaller ships between 400 and 5,000 GT, their full inclusion in the EU ETS is still under consideration. Further guidance is expected, so it is important to stay informed on further regulatory updates. It is equally important to understand which vessels are exempt from the EU ETS requirements. Not all the ship types fall under the scope of this directive. The following categories are generally excluded: military vessels and government-owned ships, ships under 400 GT, fishing vessels, sailing ships, icebreakers, and rigs or platforms. If operations primarily involve these types of vessels, they are not currently subject to the EU ETS obligations. Let's now turn to the aspect of which voyages are covered for emission reporting and allowances surrender. For voyages that begin and end at ports within the EU, 100% of CO2 emissions from this voyage are covered under this EU ETS. Additionally, 100% of emissions generated while vessels are at berth in the EU ports are also included. For the voyages that start or end at an EU port, but have the other end outside of the EU, only 50% of the emissions are covered. It is important to note that certain port calls are excluded from EU ETS calculations. These include stops made for refueling, taken on supplies, crew changes, and so on. Such calls are considered operational in nature and are not treated as part of the voyage for ETS purposes. Some specific geographies, such as small islands without direct mainland connections, are also excluded from the regulation. To discourage circumvention, the EU has introduced an avoidance prevention measure. Ports that are located within 300 nautical miles of the EU member state port are also brought under the scope. This is designed to prevent vessels from rerouting to nearby non-EU ports simply to avoid EU obligations. So, who's responsible for the compliance with the EU ETS? Let's explore that next. Under the directive, the shipping company holds responsibility for complying with EU ETS and MRV obligations. This refers to the ship owner or another entity, such as a manager or bareboat charterer, that has formally assumed responsibility for the ship's operations from the owner. Once identified, the shipping company must fulfill its obligations by working with its designated administering authority, which serves as the main point of contact and regulatory oversight. For companies registered within the EU, the administering authority is simply the member state of registration. For companies registered outside of the EU, the process is more specific. The administering authority is the member state that receives the highest number of port calls from that company's vessels over the past 4 monitoring years. If the company has not operated in the EU during that period, the authority will be the member state of the first port call. To support this process, the European Commission has published a list assigning each shipping company to its respective administering authority. In summary, who is responsible? The shipping company. Who do they report to? Their assigned administering authority based on the criteria outlined. Correctly identifying both is essential for ensuring smooth and timely compliance. Let's now tie everything together by reviewing the key reporting milestones under the EU ETS. This timeline is essential for ensuring compliance and avoiding penalties. The monitoring period began on January 1st, 2024. From this date, shipping companies have been required to track greenhouse gas emissions for each vessel in line with their approved monitoring plan. By 1st of April 2024, companies should have submitted their verified monitoring plan, which outlines the methodology used for emissions tracking throughout the year. Looking ahead to 2025, 2 major deadlines apply. By March 31st, companies must submit a verified emission report for each ship, along with the company-level aggregated report. By September the 30th, companies must surrender EU allowances equal to their verified emissions using the EU ETS registry. Failure to surrender allowances results in a penalty of €100 per ton of CO2 equivalent not covered. More seriously, if a company fails to comply for 2 or more consecutive reporting periods, the member state may issue an expulsion order, barring the vessel from entering EU ports until full compliance is achieved. This represents a significant operational and reputational risk. Understanding the cycle is not only critical for compliance, it also has financial implications for shipping companies. To explore those impacts in more details, I'll now hand over to Bernd and Joanne, who will provide expert insights into carbon accounting and financial reporting under the EU ETS. Bernd, over to you.
Thank you, Julia. Very insightful, very helpful. So we are now looking into the accounting consideration for the emission rights and obligation resulting out of emission scheme with focus on the European ETS for the maritime sector. Some general consideration first. Emission schemes are relatively new, therefore there is currently no explicit accounting guidance under IFRS or IFRS 102 that would address the accounting for emission schemes. While the ISB concluded that additional research would be needed before consideration whether to undertake a standard-setting project, so far there is no active research project, and therefore there will be still quite a while to go before we have an accounting standard. What does this mean? While there is no explicit requirements, several IFRS standards and IFRS 102 sections provide relevant guidance that entities can and need to consider. Important to note that in absence of specific accounting guidance, diversity in practice has emerged, and we will look into this now when we're going forward. Okay, now let's see on the next slide what these relevant accounting standards are. And quite important when I now talk, when I refer to IFRS standards, the same is true for IFRS 102 and the relevant section of IFRS 102. So for example, IAS 38 intangible asset under IFRS would mean section 18 of IFRS 102 that deals with intangible assets. So when it comes to the asset side, IAS 38 intangible asset, section 18 of IFRS 102, or IS2 inventory, section 13 of IFRS 102 is the accounting guidance to consider and then to apply. Whether IS2 or IAS 38 would apply will really depend on whether the emission allowance are held for sale in ordinary course of business or settled an emission liability in the ordinary course of business. So for ship owners that hold emission rights to settle their obligation, this would rather point to intangible asset accounting rather than to IS2 inventory accounting. Having said this, there's diversity in practice. When it comes to the liability side, resulting from the obligation to surrender emission allowances covered by the scheme, IAS 37 provisions or section 21 of IFRS 102 is the relevant guidance to look at. Some schemes, companies get allowance granted for free by the scheme administrative body, and then IAS 20 government grant would be in play as well. But as there are no free allowances for the EU emission trading scheme for the maritime sector, this is not relevant for our webcast, so we'll ignore this going forward. Okay, now we have highlighted which accounting guidance to consider, and therefore we will move on to look in detail into recognition and measurement. Before we do this, I just want to bring to your attention our article on accounting for emission rights, which can be found on our website. Okay, now let's look at the accounting impact on the asset side. And here we look at initial recognition and subsequent measurements for the emission allowances. On initial recognition, the emission allowances would be recorded at a transaction price for purchase allowances or at fair value for allowances obtained by ship owners from charterers. And this is true whether IAS 38 intangible asset accounting or IS2 inventory accounting would apply. The subsequent accounting would then differ, depending on whether it was concluded that emission allowances are inventory or intangible asset. Inventory are carried at lower costs and net realizable value. If intangible asset accounting is applied, an entity applies the cost model unless emission rights are traded in an active market, in which case the revaluation model can be applied. For the EU ETS schemes, there is an active market, so the revaluation model could be applied. In short, there's an accounting policy then for entities to consider. Emission rights that are accounted for as intangible assets are unlikely to be amortized, as their depreciable amount is usually nil. The expected residual value at inception will be equal to fair value, the amount recorded on day one. And thereafter, there is no consumption of economic benefits while the emission rights are held. The economic benefits are realized instead by surrendering the rights to settle the obligation under the scheme for the emission made, so to settle the obligation. Therefore, in general, there is no amortization during the life the emissions allowance are held. However, it is necessary to perform an IAS 36 impairment test or FRS 102 impairment test if and when there are indications of impairment. Before we move on, quickly, cash flow statement consideration. For emission rights received by ship companies from charterer, there is in general no impact on cash flow statements, because in general there is no cash payments, no cash changes hand, therefore no cash flow impact. For purchase emission allowances, the classification will depend on the purpose of the allowances, but quite often the cash flows will be of operating nature. Okay, now that we have looked into the accounting of the asset side, we will look at the next slide into the accounting for the liability side. When it comes to measurement of provisions for the obligation to hand over emission allowances to the scheme administrator, entities need to establish their accounting policy on how to measure and remeasure their obligation, and different approaches can be observed in practice. First of all, the provision clearly needs to be accrued as the obligation arises. So far, so good. But then when it comes to the remeasurement of the obligation at the year end, entities could select different approaches. Entities could select to measure the provision based on the fair value, market value of the allowances required to be handed over to settle the provision. And this is definitely an approach that can be observed in practice. However, important to note and to keep in mind that this approach will result in general in accounting mismatch, as the provision would be remeasured through profit and loss using year-end fair values, market values, while the emission allowances on the asset side at year-end would be recorded cost, or if they would be revalued, revaluation would go through OCI. Another approach observed in practice is to remeasure the provision based on the carrying value of the emission asset held on the balance sheet and intended to be used to settle the obligation. If there's not enough emission allowance on the balance sheet, then plus the fair value of any excess obligation, and therefore any additional emission allowance that would need to be purchased in the market. If this approach is used, then the measurement of the emission liability can be used by using first in, first out, or a weighted average basis. Again, accounting mismatch may arise if the emission allowance on the asset sides are revalued through OCI, as any revaluation adjustment would go through OCI, but the revaluation of the provision would go through P&L. Okay, now we have looked at the asset side, we have looked at the liability side. Now, in the next slide, we will look at some specific questions that we have come across. The first question, which is often asked, is actually how do ship owner account for the allowances received from the charterer? Clearly, they would be recorded as an asset when received. The question is then, what is the credit entry? Where should it go? As a ship owner has an obligation under the emission scheme and allowances are earned by the ship owner in exchange for fulfillment of the promise to the customer lessee under the contract, the ship owner would in general include a fair value of the allowances in the price under the contract, and therefore it would form part of the revenue leasing income. So therefore, when emission allowances are recorded, they're debit asset, credit revenue, leasing income. The next question that goes hand in hand with this is, how should a ship owner present the emission expense? The general view is actually these are fulfillment costs, costs to fulfill the contract with the charterer, and therefore there should be cost of sale, fulfillment cost in the profit and loss statement. Another question often asked when intangible asset accounting is used is whether to classify the intangible asset as current or non-current. As with other assets, intangible assets are generally classified on the basis they're expected to be consumed. Therefore, when entities hold carbon emission allowances with an expectation to retire them within 12 months or the entity's normal operating cycle from the reporting date, then such intangible asset would be shown as current asset, even if it's unusual to see intangible asset shown as current. In this case, it would be done. So on my last slide, I want to talk about disclosures. As I have mentioned beforehand, there are no specific accounting guidance for emission schemes, and therefore disclosures are of utmost importance to ensure that users of financial statements understand the financial statement impact of such emission schemes. First of all, I would recommend to look into the ESMA guidance on accounting for carbon allowance, where a section talks as well about disclosures. And disclosures should be detailed and clear in general, so that a user understands in detail how the emission rights are carried, how the emission obligation is recorded and measured, and how those assets and obligations impacts the statement of profit or loss. It is important to consider qualitative and quantitative disclosures. For example, the price of the emission allowances, if there is an active market, and there is one for the EU ETS scheme, might be expected to be shown and disclosed in the accounts because it would be beneficial for the users of accounts. Relevant terms and how the emission scheme works might be important as well for users to understand the impact. And next to this, then, of course, there are specific disclosure requirements for inventory, intangible asset, or provisions under IFRS and UK GAAP. And all of this must be considered to have a well-rounded disclosure so users can understand the impact on the financial statements. This is all from my side. I will now hand over to Joanne to talk you through an example. Thank you.
Thank you, Bern. We will now go through a case study so that we can bring together everything and we can see how the accounting entries would look like. As mentioned before, there are different accounting policy choices in recognition and measurement. So this just illustrates one of the possible options. So the fact pattern is that we have got a shipping company called Shipping Co. that owns a ship which is leases in a time charterers arrangement to Cargo Co. to transport goods between Spain and Netherlands. Shipping Co. recognizes revenue on a straight line basis over the period of the arrangement, and it has a year end of the 31st of December 2024. As the ship is operated between two EU ports, and this is the first year that this scheme is applicable, Shipping Co. is responsible for surrendering 40% of the relevant emission allowance to the authority for 2024 by the 30th of September 2025. In this case study, we assume the customer agrees to provide the ship owner with the EU ETS allowance that the ship owner is obligated to surrender to the authority. This is a common arrangement in the industry. However, other arrangements are also possible, and it depends on the details of the arrangement and the contract. The allowances are earned by Shipping Co. in exchange for fulfilling its promise to Cargo Co. Shipping cost includes the fair value of the allowance in the transaction price as a requirement of IFRS 15. Shipping co would recognize an asset for the allowances when it obtains control, and it would also recognize a liabilities when it has the obligation to surrender the emission allowance to the authority. The table below illustrates the assumptions on the fair value of the allowances at different times of the year, the transaction price, the contract period, which is relatively a short period in this case, and the number of emission allowance that are required to be surrendered in 2024. Now we will look at the actual accounting entries in the next slide. The revenue will be recognized over the contract period. We assume Shipping Co. would receive it in cash, so the total cash consideration is 10,000 times 180 days, so 1.8 million. As the customer will provide the emission allowance to Shipping Co., so the fair value of the emission allowance forms part of the non-cash consideration. The amount of this non-cash consideration is calculated as 400 units times the fair value of 80, giving us 32,000. In this case, the emission allowance is not received yet, so the double entries for revenue recognized over time is debit receivable 32,000, debit bank 1.8 million, and credit revenue 1.832 million. In this case, as Shipping Co. will use the emission allowance to settle its own obligation. So when Shipping Co. obtains controls of the emission allowance from the customer, then it debits intangible assets 32,000, credit receivable 32,000. We will now move to the next slide to look at the accounting entries for the liability side and subsequent measurement. Shipping Co. recognizes a liabilities with an expense when obligation to surrender the emission allowance to the authority arises. There is a general consensus that this is a cost of sales because it is an expense for revenue generation. Therefore, Shipping Co. debit cost of sales, credit liability 32,000, which is the fair value of the emission allowance. Now, Shipping Co. has done its initial recognition of asset, liability, income, and expense. At the year end, Shipping Co. needs to consider subsequent measurement of the asset and liability. As we discussed earlier in the other session, there are different options available for remeasurement. If cost model and the initial carrying value approach are adopted, then no revaluation will be required for both intangible assets and liability. As an active market is available for emission allowance, Shipping Co. chooses to adopt the revaluation model for intangible assets. It also chooses to remeasure liabilities at market value at the year-end date, so the infreq-free approach is adopted. In this case, the fair value of each unit of emission allowance increases from 80 to 92 for the 31st of December 2024. The intangible asset of Shipping Co. will be remeasured to capture this increase in fair value. The total increase in fair value of the 400 units of emission allowance is 12 times 400 units equal to 4,800. Therefore, the double entries to remeasure the intangible asset is debit intangible asset, credit fair value movement on intangible asset in OCI, 4,800. As the infreq-free approach has been adopted for subsequent measurement of the emission liability, it needs to be remeasured at fair value as of 31st of December 2024 as well. Therefore, the double entries to recognize the increase in fair value of emission liabilities is debit cost of sales, credit liabilities 4,800. This case study illustrated the basic accounting treatment of emission allowance. As mentioned quite a few times in this training, the accounting treatment of emission allowance depends on the purpose of obtaining them, how they are obtained, and the chosen accounting policy. Therefore, it is important to understand the facts and circumstances to determine the correct accounting treatments. Today, in this little training module, we have gone through the details of the EU emission trading scheme for the maritime sector, We also discussed the different options of accounting treatments for emission allowance. Finally, we used a case study to apply what we have learned in the 2 previous mentioned sessions. We hope you find it helpful for navigating emission allowance accounting. Thank you for watching this video and have a good day.